And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the pre-holiday edition of The Real Investment Show. It's hump day. It's also the second best day of the week because it's the day before a holiday. Then we have Friday, which is the best day of the week. And then, it's Saturday. So weekend is almost here. For most people, Friday's a holiday too. So, just there you go. But it's going to be a very light trading today in the market. So again, this whole week has been that way. So don't take a whole lot of anything from the markets. But we'll talk about that in a second. Interestingly enough, there's a report out this morning that said the cost of feeding 10 people at your Independence Day celebration is up 5% this year. And it's going to cost you $71. Now, I don't know what you're feeding people with. If you're feeding 10 people with $71 in today's market, what is it, like one hot dog a piece, one little bag of chips and a drink? I mean, I guess you could do that, right?
We're talking real nutrition here.
Well, we're not talking about that. We're talking about you're not going to have any friends after that party. So, or right? You're feeding 10 people on $71, which means you're providing the drinks and everybody else is bringing their own food. So I don't know how you do it, but this is government reporting for you at its finest. I mean, when was the last time this guy had a backyard barbecue for $71 for 10 people, period. I just fed 6 contractors at the ongoing saga of my electrical problems at my house. Finally, yesterday, all the electrical's back on, and we are back in the house. But I fed 6 electricians the other day, and it was almost $220. So I don't know how you do it for $71 for an Independence Day holiday.
Not with barbecue.
Yeah, not with barbecue. That's for damn sure. Hey, barbecue. Also, today is a very sad day. We have to have, today is a bit of a memoriam. And because we had a very serious set of deaths in our house over the last couple of days. It's been just a very traumatic few days. We lost our new coffee maker. We lost our air fryer. And we lost our oven. So,
wow.
Yeah, just so when this power surge came through the house, it basically, I was fortunate that a lot of other electronics, of course, I put everything on surge protectors, but you don't think about putting a coffee maker on a surge protector. And they were plugged into a GFCI switch, so that didn't even help. That's how big the surge was coming through the house, but. Yeah, I've not had coffee for 2 days, so just beware. I don't know what you're going to get this morning on the show, but I'm a little cranky. So.
Now, that wasn't your oven, was it?
No, it's a rental. But it was my air fryer.
Yeah,
and remember, I just bought that brand new Ninja coffee maker, which is awesome, by the way. And thank you to Chat, who made the recommendations. When we were previously talked about losing our coffee maker, our Cuisinart, which leaked like a sieve everywhere. Thank you to Chat, who recommended the Ninja coffee maker. Highly recommend, right? Cuisinart, 1 star, would not recommend. Ninja, 5 star, definitely recommend. It was a great coffee maker. We enjoyed it for a couple of months and it's now dead. So anyway, burial will be at noon if you want to show up. And
or whenever the trash is picked up.
I think that's around noon today.
Yeah.
So, but anyway, so that's what's been going on in the household as late. But thankfully, internet's back on. House did not burn down when they turned the power back on. So this is all good stuff right now. My landlord, not so happy.
Have you had the talk with the landlord?
Yeah, I had the talk last night with the landlord. He's not very happy at all. He wasn't happy about which turned out to be like close to 15 grand to fix all this stuff in the house. So, but see, that's what you get for cutting corners when you do remodels. Don't cut the corners. They come back and get you eventually. Anyway, all right, a couple of things this morning. Like I said, look, it's holiday shortened week. Everything is very, very tenuous, in the markets. Markets did hit a new all-time high yesterday. S&P 1500. Now, you can't really tell, right? Now, you listen to the headlines this morning, and headline right now, CNBC. S&P 500, NASDAQ up 5 of past 6 days. New record high, S&P 5500. Absolutely true. We hit that yesterday, but, I mean, it is just barely a new high. So again, marginal new highs, not surprising. We're still just well entrenched in this kind of consolidation range at the moment. And again, very light volume here. Traders are gone for the most part. Markets are likely going to be up a little bit today. So again, but we could open up strong, sell off. I mean, no telling what's going to happen, because tomorrow is all markets are closed tomorrow for sure, and half a day on Friday. So again, just really kind of stuck in this kind of sideways consolidation at the moment. But we continue to just run along that 20-day moving average. And as we continue to kind of make this advance, the market consolidated, the 20-day moving average caught up to the market. And the market kind of touched on that, bounced off of it, and that was that rally that we had yesterday. So, this is just kind of the market action at the moment. That 20-day moving average continues to act as support. July tends to be a fairly positive month. So again, I would kind of expect this market to kind of continue this kind of sideways, slightly higher, trend in the markets. There's not really much at the moment, to create a really sharp jump in the markets. Now that could happen. Again, we've got the employment report coming up. We've got a CPI report coming up here soon. And also earnings season is also really starting in earnest next week. So if we get a really, really weak employment report, which isn't great, right? Economically, a really weak employment report is not great for the economy. That means people are losing their jobs. That's not healthy, but it's good for the markets because that means the Fed will cut rates. That could lead to a fairly sharp jump in the markets. Also, a weak CPI report also would suggest the Fed may cut rates sooner than later. Starting to see expectations for Fed rate cuts time to start to creep up here a bit. Towards maybe 3 rate cuts again this year. Markets kind of get a little bit ahead of themselves. But again, that's going to be some of the news that comes out at the end of the month, end of July. We've got the next Fed meeting. So the markets are really going to get trading off that Fed meeting here over the course of the next month. And as I said, July tends to be a fairly decent month for the markets. And remember, this time last year, in fact, I just posted a chart on Twitter this morning comparing year-to-date returns from this year to last year, and they're almost identical. The market trajectory is identical at this moment. And what happened in July last year is we had a fairly sharp jump mid-July, and then that was the peak of the market and had that correction through October. So again, as we kind of get pre-election, we keep talking about this potential for a 5 to 10% correction. That's still very much in the cards. A very big deviation right now between the markets and this 200-day moving average. That's going to act like gravity here. So again, just continue to, don't be bearish, but just continue to manage your risk, rebalance your portfolios, take profits, do those type of things. Hedge yourself a little bit, because as we get further into summer, that risk of that correction is going to rise. That's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff and Fintech's false promise and what happened there. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I've got Danny over here monitoring the chat, so y'all behave. Back in the early 90s, now I know this is, I was talking to my son last night, and we were sitting around and visiting, and we started talking about electricity. And my wife asked the question, she says, well, when was electricity first discovered? Right? It was like 1826 was when they first discovered electricity. And my son pipes up and is like, Dad, were you alive then? So it's like, almost. It was just a little bit before my time. But, when you start talking about the 90s, it seems so long ago now. But back in the early 90s, the Hunt brothers tried to corner the silver market. And so they were buying contracts for delivery of silver, et cetera. And what they figured is that they could drive the prices of silver up. They could kind of corner the market by, buying all the deliverable supply. And it was in theory a good strategy, right? If you have the money to do it and you can take delivery of the commodity, whatever it is, sounds great. The problem was it failed miserably. And this is always the issue when it comes to commodities of pretty much any type. There's a tremendous abundance of commodities, and particularly when you start talking about things like copper. Silver is another one. And as the Hunt brothers discovered, there's more silver than you can imagine in the world. And what happened for the Hunt brothers is that when prices of silver got high enough, everybody started selling grandma's silverware. They were scraping the back off Polaroid film, which had a silver content to it, to get to the scrap. And there was just so much of this stuff out there that they just could not buy enough contracts to actually corner the market. So they kept going deeper and deeper and deeper, and more supply kept showing up. And eventually it all crashed and burned as supply exceeded the underlying actual demand. And, so we see this every time there's a big run up in copper, people or silver or anything else, people get very excited. It's like, oh, this is it. It's going to go to the moon. And here's the fundamental case for why it's going to go to the moon. Same thing for oil prices. We keep getting predictions. Oil prices go to 150, 300, whatever, and then a bunch of supply shows up. And that's always the problem with commodities of any sort, is the supply versus the actual underlying demand. And so copper prices have been on the rise. Lately because of the whole idea about, power generation for AI and all this. And it's not surprising. There was a tweet out there, Brent, if you can bring this tweet up. This is a tweet from Electrify America. Now, remember that the Inflation Reduction Act provided several $1 billion to build chargers in different areas of the country. Now, a lot of these electric chargers, these EV chargers, were built in less prosperous counties and cities, or areas of cities where people don't actually own EVs, but they built them there anyway. But one of the big surges right now is for people to steal the charging cable, because there is a lot of copper in that charging cable, and they're very easy to steal. So Electrify America says, EV community, we need your help. We're asking for your assistance in spreading awareness to put an end to this cable theft in Seattle. If you have any information that can help stop cable theft, please contact Crime Stoppers at Puget Sound, 1-800-222-TIPS. So if you happen to know this guy, by the way, if he happens to be a family friend or relative, you can call the tip line and have him taken care of. But this is the whole point about commodity. When commodity prices rise enough, commodities are a tradable commodity. They're not buy and hold. You buy a commodity for a trade, and you have to make sure and sell it because they regularly boom and bust over time, and that's because supply will show up. Prices get high enough. And we talked about this on the show before. Back the last time that we had this type of commodity boom going on in terms of copper, people stole all the cable from our radio transmitter tower, and we were off the air for a couple of days because there's a ton of cable and copper cable in transmitters. So always happens. AC units, refrigerators, all kinds of stuff. We just had a rash of this stuff not too long ago here at the building. Catalytic converters.
Yep.
Yes, they show up in the garages and cut the catalytic converters off your car. So anyway, it's always interesting. Talking a little bit about the market real quick. Brent, I have one more chart here for you. Just 1 second. Talking about the market just real quick this morning. I said that this year's playing out very closely to what we saw last year. And I built this chart last night. This is in the daily commentary today. So if you go to our website and get our daily commentary for today, will be emailed out. It's published now, but it'll be out at 7:30 by email. So if you subscribe, it'll come to your email inbox. But we produce, market commentary every day to help you trade better, understand what's going on in the markets. But I compared the year-to-date returns, that's the orange line, compared to the blue line, which is last year, 2023. And this year is tracking very closely to last year, and it's all kind of the same premise. The AI chase and artificial intelligence and Fed rate cuts. And so everything that was driving the markets, corporate share buybacks, which are pushing a 4-week record right now. But the same thing driving the markets last year, driving the markets this year. And as we were discussing that, over the next 30 days, as we push through July, and just like we saw last year, the market kind of made this push higher in July. Earnings season was going well, AI, NVIDIA, blah, blah, blah. And then we had that 10% correction into October lows, and then the rally into year end. And it was a really strong rally. That November-December rally was very, very strong last year. That's a very reasonable setup for this year as well. A rally into July, correction September, October for the election, post-election, whoever gets elected, markets rally, positioning for the end of the year based on that. Historically, when you have a 15% up year in the first half of the year, which we have, the end of the year has always been strongly positive. So just market statistics as well. But it's just interesting there's such a high correlation between this year and last year, almost percentage point for percentage point advance, at this juncture.
Yeah, it's interesting, though. I think a lot of people are really concerned, though, Lance, as far as, maybe it was cautious optimism, I feel like. And now maybe it's like, whoa, this thing has gotten, way over its skis really quickly. And, you've mentioned taking profits and maybe trimming a little bit along the way. But go a little bit further in detail with that, because I'm getting a lot of questions. I know a lot of people, you guys out there, are probably thinking this. What should you really be doing? Because I'm hearing, like, hey, we need to just get out of equities, or we need to reduce it substantially. It's like, hold on.
Yeah.
That doesn't mean just because all the things you just mentioned, it's very close to a mirror image. I mean, market participation, the whole nine. But this can always be different, and statistics are still on your side, right?
Right, yeah. And again, just like we did last year, as a good example, last year at this time, we were talking about a 5 to 10% correction. And that we started kind of taking some profits. And by taking profits, it doesn't mean sell the whole position. So let's say you own NVIDIA, as a good example. We've bought and sold NVIDIA numerous times along the way. We never sold the whole position, right? We just bought and sold parts of it. And so when NVIDIA gets way over its skis, we trim it back to target weight. So let's just say that your portfolio, and you should have in your portfolio a set of risk management rules. And risk management rules revolve around sizing as much as anything else. So how big should a position be in your portfolio at any time? And you need to suggest that, say, okay, I'm not going to have any position in my portfolio over 5%. And you can pick whatever number you want. But the way you account for that, or how you judge that for yourself, is to say, okay, if this position goes to zero tomorrow, which can happen, right? You can wake up one morning and a company files for bankruptcy, whatever it is, and the stock goes to basically zero overnight. It happens more often than you think. But if that 5% position or 4 or 10, whatever size it is that you're good with, if you say, okay, if that goes to zero tomorrow, that's going to be the impact to my overall net worth, investable net worth. And can I survive that? And if the answer is no, that position size is too big. If you lost 10% of your portfolio tomorrow, would it financially cripple you from reaching your goals? Now, if you can lose 10% of your investment portfolio, but you've got another, buku of money somewhere else, then you can take all the risk you want in your investment portfolio, right? Because if that portfolio goes to zero, it doesn't impair your ability to retire financially. So, you have to look at these things like that and say, okay, I'm not going to take more than a 5% weight in any one position. That's our maximum weight. We can't own more than 5%. Now, some positions we assign a lower maximum target to because of volatility or risk or whatever it is. But if the position size grows to be, so let's say just, easy math, let's say NVIDIA makes up 2% of our portfolio and it grows to 3%. And we say, hey, let's take profits out of it. We reduce it back to 2. You don't sell the whole position. You just move it back to your original target weight. Take that excess risk off the table. So you do that across your portfolio, rebalance between offense and defense a bit. And then when the market downturn comes along, you have raised some cash and you have that ability, like we were doing in October of last year. We were buying during the mid to late October period, adding money back to our portfolio because we said, hey, we're about done with this sell-off and we're probably going to, and I wrote a whole article that's on our website talking about October weakness before the year-end rally. And that's why we were positioning that way. We said, we're going to get a year-end rally. Here's the 3 reasons why. And of course we did. And a lot of that was stock buybacks driving that. But just manage your exposure. Doesn't mean sell everything and get out of stuff because you don't know how big the correction is going to be. And again, a 5 to 10% correction, completely normal in any given year. You can do nothing and live through that, right? But a little bit of management just kind of helps keep your sanity while you go through a correctional process, right?
Yep.
Markets aren't going to crash. We're not going to wake up and be down 30%, 40%, or as Adam Taggart was talking about last week, 70% correction market. That's not going to happen. Not this year. All right, be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the last 2 years, there's been a massive drop-off. Like, nobody's naming their kid Alexa anymore. But yeah, because you go, Alexa, stop that, and all your lights go off.
The Real Investment Show podcast.
And I'm sure the kids at school were getting teased. You know, hey, Alexa, ask a question.
Same show, your schedule.
I hadn't heard of any kids being named Siri.
Not yet. I'm sure there are. I am sure there are. And there's probably some kid named Bixby somewhere.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, first of all, I just want to say that Adam Taggart is a very, very dear friend of mine. Love him to death. We have a conversation every Friday. Today's we're actually going to shoot our video tomorrow, but we have a conversation every week on the Thoughtful Money channel as well as other places. So don't mistake anything I say, as negative towards Adam, because absolutely not. We just have a little bit different view about managing money, and it was interesting because, if he recently interviewed Jon Huntsman, who I also know Jon Huntsman. And Jon Huntsman is very, very methodical in his analysis. And he is, comes off as very bearish, right? If you listen to this, read some of the stuff he writes, and I encourage you to read his work because he is a genius. He is a very, very smart man, much smarter than me, anybody else I know. But he just has a very specific view. His family is doctors, so he approaches investing and markets from a very methodological. Never mind that word. I can't spit that out this morning. But he's just very pragmatic about how he approaches his analysis. And he just did an interview with Adam Taggart, and I encourage you to listen to it. The title of the video is Markets to Crash by 70%. If you listen to his conversation, and again, this is the problem, most people don't actually listen to what is being said. They just read headlines. What he says is that it's a potential outcome. And he said, just like a doctor, he says, there are symptoms in the market that have previously led to bad outcomes. And he says, look, just because if you've ever, here's basically summing it up this way. If you've ever had a symptom of something, right? You got a rash on your arm, right? Something like that. Go and Google rash on my arm with something like WebMD, and you will be guaranteed that you have cancer, right? It's never self-diagnose on the internet. It is the worst thing that you can do because you are going to get the worst possible outcomes. Of course, your brain starts, imagining the worst outcomes, right? Oh my gosh, I'm going to die next week, blah, blah, blah. And it turns out you had poison ivy, right? That's what Jon Huntsman is getting to. He's like, look, there are symptoms here, but as he repeats numerous times, and if you listen to about the 31-minute mark, he says, these are symptoms. But this market can do a lot of other things. Just because you have the symptoms of cancer doesn't mean you have cancer, right? It's the same thing with the market. So you have to listen to him. He is not predicting that the markets are going to crash by 70% this year or next year. He's saying we've got symptoms, right? There's some things to be concerned about, but you have to invest for the market, which is what our job is with you, is to talk to you about how to navigate this market every single day, because we manage for what we have, not what we're thinking we're going to have. I had a topic to get to this morning, talk about Fintech's false promise. We're not going to get to it because I want to go through some of the comments that you're making in chat this morning, because they're good relating to this topic. Iconoclast said there's a lot of due diligence. Pick one stock, figure out when to buy it and sell it. That's fine, right? If you're really adept at managing risk, I know people who trade single stock portfolios, and you can do really, really well. You can also go bankrupt really, really, really fast. Because what happens with a lot of people is they enter this thing going, oh, I'm going to use some analysis that tells me when to buy or sell this, but they don't follow the discipline. The discipline of single stock investing is extremely important. Howard Marks, who is the kind of the CEO of Oak Tree Capital Management, trades distressed credit. He's a genius investor. Very well respected. He talks about psychology all the time and discipline and the things that you have to do in order to succeed in investing over the long term. What happens with most people is that they enter into the investing game and they take on an excess amount of risk. Concentration risk is one of the biggest issues that happens with most investors. They get really, really overweight stocks for some reason. A good example of this was in 2006, 2007, also 1998, 1999. Those two periods in particular. 1998, 1999, Danny will remember this, Enron was the darling of Wall Street. And they're located here in Houston, where Danny and I both reside. And I had numerous clients that worked for Enron, and we were encouraging at the time our clients to reduce those position sizes in Enron sharply in 1998, 1999, because they were just so overvalued and so stretched beyond any type of reasonable positioning, right? But of course, a lot of people that worked at Enron, they were into the whole culture of Enron, and they had their entire 401k plans invested in Enron stock, and they were making a killing. I mean, these people had 3, 4, 5, 6. I had a secretary that I worked with as a client at Enron. Could not get her to sell her position in Enron. She was worth almost $10 million as a secretary at Enron back in 99. By the end of 2000, 2001, she had no money. That can happen very quickly. And like I said before, it can happen much quicker than you think. So you've got to have a very steel-like discipline. As I said, Howard Marks says you have to be like a Vulcan. You got to be like Spock from Star Trek and have absolutely no emotion tied to a stock, the value of your portfolio, anything else. And as long as you can do that, you can be a very successful investor trading single stocks. But you've got to have a very strong thesis. You've got to have the research. And most importantly, you've got to have the discipline to say, I'm wrong.
I think that's the tough part, though, Lance. Everybody, once you get a really good, intimate knowledge of a company, what I have seen historically is that you get a little bit too confident, right?
Right.
You start saying, oh, you know what? Okay, it's been doing this.
But the outlook is so great.
It's great. It's going to keep happening. So instead of taking profits at 5%, I'm going to move that up to 10. And you know what? I'm going to give it a little bit more wiggle room because it's become a little bit more volatile, right? And that's where people get in trouble, is that we don't follow that discipline like you mentioned. And all of a sudden, it's a different ball game, and the risk parameters change very quickly. And so, going back, like you mentioned, looking at, early 90s, early 2000s, we have these old school risk questionnaires, and everybody's probably taken one of these, and most advisors have them. It's a compliance deal, and it's trying to get to know the psychology behind an investor and really the behaviors. And what we find is that when markets, at least with these old ones, like now we have one, it's like you're taking one of those psychology tests to get into a new job. But what happens with the old ones is that if the market is doing well, most people will skew that to say they're more aggressive. If we're in a down market, most people will be much more conservative with their answers, right? They kind of know how to game the system. And the problem is that we're not doing ourselves any favors because inevitably we're a little more confident. The market's gone up. We've got to get money in, got to stay invested or get invested for many folks that have been out.
Right.
And then the market crashes and like, oh my gosh, I'm down much more than I expected. What's going on? And then it's the complete opposite. When the market goes up, we're in a downturn and somebody says they're super conservative. Well, why are we not participating? Well, you didn't want much exposure to equities. And so sometimes we're our own worst enemies by design, and it's not intentional, but it's kind of self-preservation in a lot of ways. And we screw this up along the way. And it's kind of like, we see a lot of people that hop from different types of models. And I can almost every time go back. And there's times that maybe you need to, right? It's psychology. I told somebody yesterday, I said, listen, there is no amount of return that you can get that is worth your sanity, your health, your sleep at night. None. And it's kind of counterintuitive to hear that from an advisor. But you've got to know yourself. And so if that's what you need to do just to, stay healthy, stay alive, great. But you've got to stay in the game. And the problem, though, that when we hop, we're usually doing it at the wrong time.
Yeah, because you're jumping from what isn't working to what was working.
Yeah.
Right? Which is also about the time that what was working doesn't work anymore.
And it changes.
Exactly. When we come back from the break, we're about up on a break, and I want to get into this when we get back. A lot of you in the chat are talking about, buying, Warren Buffett buys Oxy, so every time, it dips, buy Oxy because Warren Buffett's doing it. One thing we'll talk about when you come back is about doing your own research and not relying on the research of others. Because, again, we all revere Warren Buffett. I do too. Very smart guy. But is it the best idea to rely on Warren Buffett's research for your portfolio? And so we'll talk about some of that when we come back. Real quick, I did want to hit this one since we titled our topic this morning about Fintech promises. It was very interesting. Fintech was the whole big rage a couple of years ago. Everybody was digitizing everything, right? It's like, digital banking, digital investing, yada, yada, yada. You got to be real careful about where and what product you use. Just because it's on the internet and it's a Fintech thing, you got to be real careful, because if it doesn't work, and a lot of these companies go bankrupt, if you're invested in that company when it goes bankrupt, in other words, you're handling your banking through them or whatever it is, you can wind up in a very bad position. That's what happened for a lot of these customers that Fintech promised them the best of both worlds: innovation, easy to use, fun. They had newest apps combined with safety and government-backed accounts at real banks. They failed, like for the collapse of Synapse, and more than 100,000 depositors with $265 million in deposits have been locked out of their accounts. Be real careful. Make sure the company is solid before, just because it's on the internet doesn't mean it's a good company.
Well, that FDIC insurance looks a little bit different from a traditional bank to that.
Exactly. All right, quick break about Warren Buffett and investing like Warren Buffett. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. Few comments in the chat talking about investing like Warren Buffett, and nothing wrong with that. As I said before the break, Warren Buffett's been investing for about 1 billion years, been through every market cycle there is, very successful. So, nothing to knock, right? If you go to our platform, simplevisor.com, we have the portfolios for all the big major investors. We track their 13F reports every quarter, and we post those on our website. So you can see exactly what Warren Buffett holds at any time. And, so you can look at all the different major players, Sequoia, et cetera, and see what they're holding, right? So you can kind of model that. But the problem with, unless you, and the comments in this section or in our chat are talking about buying Oxy, because Warren Buffett's been buying Occidental Petroleum. And stock really hasn't gone anywhere. It goes up a little bit when he's buying. It goes back down to where it was after he stops buying, and it just trades sideways. So that's okay, right? Nothing wrong with that. Here's the problem. You're banking your research, right, on Warren Buffett, which is fine. Again, very smart guy. The problem is you don't have his time frame for that investment to work. He's not buying Occidental Petroleum today for it to make money tomorrow. He doesn't care, because he does not, when he reports the performance of Berkshire Hathaway, he doesn't report actual performance of Berkshire Hathaway. He reports the overall profitability of the company. And it's very different. Price performance and profitability come two very different things. Book value is what he reports. So he's buying Occidental, but his time frame is 100 years to work. And so you don't have that time frame. So if you're banking your entire portfolio on Occidental because Warren Buffett's buying it, that's fine. But you may be winding up holding a stock that goes nowhere for a very long time. But the other part of this is also understanding that Warren Buffett is wrong from time to time, has been wrong from time to time. Liberty Media, Hewlett Packard is a good example. Warren Buffett just liquidated his entire position in Hewlett Packard because it didn't work. So when he bought the company, it had a thesis, right? His holding time period was 100 years for Hewlett Packard. Everything he buys, he looks for a 100-year holding period, because Berkshire Hathaway is going to outlive Warren Buffett. It will be here long after he dies. There'll be new managers. Warren Buffett will go away. There'll be a new manager for Berkshire Hathaway, and the fund will continue to exist. The company, Berkshire Hathaway, will continue to exist. You don't have that long. But again, there's a very big difference in the duration of Berkshire Hathaway and the duration of your portfolio. So just because he's buying Occidental doesn't mean it's a good investment for you. That's why you have to do your own research and manage your own portfolio for your risk and your potential returns, and most importantly, your durational time frame, and realize that, yeah, he's buying Occidental. He may very well in 6 months or a year or 2 years from now sell the entire position if it doesn't work.
He may, but we also need to understand and realize that him buying Occidental, or any company for that matter, is way, way different than you and I purchasing it, right? He's likely going to get a seat on the board. He's going to be able to put people in place. He's going to have preferred dividend potentially. I mean, think about how many times he's bought a company or a portion of it, and he's called his own dividend. I mean, this guy calls his shots, right? You got Warren Buffett here. So this is much different than you and I going out and purchasing a company, a stock, buying one share. He actually has some skin in the game in the sense that he can provide some direction, some oversight. He knows management intimately, which you may think, okay, well, this is great, but you also don't understand maybe what he's also getting on the other side of the ledger, in the sense of he may have bonds he's purchased that are going to convert to equities. He may have a better dividend deal than what you have. What was it? Was it Goldman or Wells Fargo where he negotiated a deal with like 10% dividend? Yeah.
Yeah. And that's what he actually said in his latest letter. You know, he's holding about 180 billion in cash. And he's talking about that, you know, he's prepping to be able, he's like, the reason we're holding so much cash is that when the market ultimately has a reversion correction, which will happen, they want to be in the position to take advantage of that by doing exactly what they did during the financial crisis, which is you go to Goldman Sachs came begging hat in hand to Warren Buffett saying, we need capital or we're going out of business. And he's like, sure, I'll give you capital. I want 10% preferreds. I want all these extra warrants. And Warren Buffett made an absolute killing out of that deal. But that's the advantage of having cash available and being liquid when opportunity arises. And that's a big part of your portfolio management. It's you should never be 100% invested in anything. Just because markets are going up doesn't mean you have to buy anything. The opportunity to invest is when you find a real opportunity, something is mispriced in the markets, something has a very big correction for not a real good fundamental reason. I'll give you a good example. Palo Alto Networks a couple of quarters ago announced earnings. Their outlook was not as much as Wall Street wanted. The stock corrected by almost 20% the next day, but that correction was not really justified by either their outlook or their fundamentals. It overcorrected on the valuation wise. So we bought a position in Palo Alto Networks. We're up about 24, 25% in that position now since we bought it. But those are why you have cash available. And that's why you manage your risk and always have that opportunity. So when you see a mispriced opportunity, you can take advantage of it in your portfolio. And that's what Warren Buffett does all the time.
Yeah, and I think so. Pistol Pete mentioned on the chat that, Warren doesn't buy a company for a 100-year time frame, right? He buys it now because it looks attractive, which obviously correct. The difference is that we all have a finite time period, right? We have whereas we can't go forever like a company can, right? So the difference would be is that as we have during our lifetime, we're going to need these funds. We're going to use these funds. That's probably not the case. So if you had to hold these funds, if Warren Buffett did, he could. Whereas we're going to use these typically for cash flow, for retirement needs, for expenses. Most people don't have that flexibility to just say, I have this net worth built up. I'm going to let it sit. We're going to grow it. It's for the next generation, not worried about it. So we've got to understand the difference in investing in that aspect.
Yeah. Larry made a comment. It's like, I found something that goes up and down like clockwork. That works great for a little bit of time, generally. What you've got to be very careful of is that you can look at a stock, and every time a stock gets to a certain price level, it goes back up. And every time it gets to a certain price level on the upside, it sells off again. And that works for a while. And it could last for a long time. It's like, man, every time this happens over the last 2 years, every time the stock has gotten to, X dollars, buyers come in, they buy it, and it goes back up. And then one day it gets to that level and you buy it, and then it keeps going down. It's like, okay, well, it's always held support at that level, and now it's taken out that support. So, but it'll come back. Right. And this is where you get yourself into that trap. And yes, you can trade stocks in ranges, and certainly nothing wrong with that. If you're a good active trader, Trading stock ranges is a great way. You trade breakouts to the upside, you trade breakouts to the downside. And if you're adept at technical trading, absolutely a good way to make money. But you have to have a very strict discipline of when it takes out such and such level, I'm out. Or when it goes above this level, I'm taking profits. And the problem is that most people walk themselves into the psychological trap of it breaks out. Okay, well, as soon as it gets back to that level, I'll sell it. And then it keeps going lower. Good example was Cisco back in 1998, 1999, 2000. Stock was about $80 a share, traded in a really strong range. You could trade that stock all day between 60 and 80. And then it went to 60. And then it went to 40. And then it went to 20. And that's when people find religion and foxholes and stock market crashes because they're going, oh, God, please just get me out of this thing and I'll never invest again. So just, Larry, I'm with you on Oxy trading. You can trade that bottom. We look at Oxy all the time. Trade that bottom in Oxy. If it breaks it, you got to go because something will have changed. Oil prices collapse, whatever it is. And that stock is not keeping up with the energy market, which is also something you need to be paying attention to. Why, just because Warren Buffett likes it, why does the rest of the entire investing world not like Oxy as compared to, say, an ExxonMobil or something else that's doing a whole lot better price-wise? What is it that you might be missing, or even Warren Buffett might be missing? Because, again, he's been wrong on stocks. His thesis may not be right. And that's what you've got to figure out as, for your own self.
Yeah, and what does he see that nobody else does?
And it's possible too.
Could work in reverse.
Absolutely. And just nothing wrong with that. And I'm just saying is that there is risk, and you should never bank your investment research on me, on Danny, on Warren Buffett, on anybody. We're managing our portfolios the way we feel is the right way to manage them. We manage risk the way we feel is the right way to help protect our clients. That's our job. But you need to do your own home. If you're investing your own money, do it yourself, all right? Just make sure you're doing your own homework, coming to your own decisions. And please make sure you've got a very strong discipline about taking profits, rebalancing risk, those type of things.
Yeah, and that's the more difficult thing to do is actually adhere to that discipline. So keep in mind as you're doing that, build those parameters, write them down. I think that's the problem too often is that, if we don't write them down, I'd put them on a big poster and say, here's what we do and here's how I'm going to do it. Because if not, I think it's easy for us to kind of change those over time.
No, absolutely. And in fact, I hope I have time to get this before we hit the top of the break. But if you actually go to our website, type in investing rules in the search bar. We've got several articles we've written about trading rules, and you will find investing rules to navigate volatile markets. There's 15 rules in there that you can follow. At least give you a start. All right. Have a great holiday. Tomorrow is Independence Day. Danny, thank you so much. Enjoy your Independence Day. I don't know how you're going to feed 10 people for $71, but good luck. Enjoy it. And we'll see you back here on the next edition of The Real Investment Show.